Good afternoon, everyone, and welcome to the next installment of Michigan First virtual series on credit awareness. My name is Alyssa Kinzel, and I oversee the credit union's financial literacy program, Money Mentor. I'm so excited to partner with our lending team today to host this important event. You're probably wondering, Money Mentor, what is that? So Money Mentor is a free financial literacy program that Michigan First offers, and as a certified credit union financial counselor, I can help provide expertise and guidance about budgeting, borrowing, and financial wellness based on what I've encountered over more than 10 years in the financial sector. So Money Mentor offers customized in-person and group presentations to equip you with the tools necessary to understand and take control of your finances. If you have a group of 10 or more that you think could benefit from this service, please feel free to reach out to me through michiganfirstmoneymentor.com, or you could send me a chat through our Zoom here with your information and we'll get connected. More importantly, though, in this installment of our quarterly webinar series, you will receive information on the importance of maintaining a strong credit score and what it can mean for your financial wellness long term. Today, we're fortunate enough to have with us credit guru and underwriting manager for the credit union, Noel. Brock has been with the team for nearly 15 years, and he's worked in the financial service industry for more than 20, educating not only our team, but many of our members on how to best manage their credit and financial challenges to ensure that your cost of borrowing remains affordable. Before we get started with anything, I do want to just note some things very quickly. The chat feature within the presentations platform will be your opportunity to present questions to us. No real-time audible questions will be taken today. We have everyone muted and videos are also disabled, so please feel free to direct message Jamie Baker or Jeff Fitrzyk via the chat feature with any questions you wish to have addressed at the end. In addition, the information presented today should last about 20 to 40 minutes, and then we'll take some time to review and address some of the questions you have before we end at no later than 1 p.m. And with that, I will hand the presentation over to Brock to begin. Thank you, Brock.
Thank you, Alyssa. Appreciate that. All right, everybody. Thank you for attending today and welcome to everyone. I'm going to go ahead and share my screen so you guys can see the presentation. There we go. Just want to thank everybody for spending some of your time with us today. Really appreciate you taking the time to be with us today. Now, we're very excited to have the chance to talk to everyone regarding credit. We certainly pride ourselves as a credit union in the education aspect of our day-to-day lives. And this is a great opportunity for us to offer some insight into something that we do day in and day out. For those of you who don't know, this is our second virtual seminar that we've done this year. If you're interested, that first one from May is available. You can find that actually on our website. So I would encourage all of you who missed that one to give it a view. Whereas the last seminar, we did more broad-based focus on credit. Today, we're going to be more specific, be more calculated and targeted. We really want to talk about how you can use your credit score as a financial asset. All right. And by that, I mean, how can you have your credit score impact your wallet? Because dollars and cents matter to all of us. We want you to be able to use your credit score to your advantage so you can save yourself some money. We want to also spend some time today talking about how you can improve your credit score so you're able to do that. And when times are tough, because life throws you curveballs sometimes, what can you do in those tough times to maintain a high credit score? Or if worse comes to worse and you have to rebuild your credit score, what are some tips and techniques for doing that? So with all of that being said, why don't we get started with this presentation? We all have credit scores, whether your credit score is 0 because you don't have any credit or you haven't used it in a while, or you're one of the lucky ones that's all the way up over 800. We all have that 3-number score. And why does that matter? What does that score do for you? Is there a big difference between having a 700 or 800 credit score and having a 600 or a 500 credit score? What does that mean to us as consumers on a day-to-day basis with how we spend our money? So to start off, we want to show you why credit scores do matter. And we want to give you an example of what a loan would look like for an individual who would have an A+ credit score. So for those of you that are over 720 versus someone who may have an E credit score, that would be any individuals that are less than 600. What does it look like to have the same loan? So for this example, we're going to look at a $25,000 car loan. All right. That could be, just for this example, let's say it's a Chevy Impala that you want to buy, $25,000. All right. So member number one has a 722 credit score. That's an A+, and they want to finance that car for 5 years or 60 months. The rate that they're going to get in a typical market, I know they're a little bit higher right now, is going to be about 3%. So for this example, let's use 3.24%. So for that individual financing that $25,000, their payment's going to be about $452, pretty manageable. Now, the amount that they're going to pay in total, once you include that interest for that car, is going to be $27,000, just over $27,000. So really not that much paid at interest. That's pretty good in the market. Now let's look at the other member. Maybe they fell on hard times, whatever happened in their life. Their score is a little bit lower. They're down at 542. They're going to get an E score or an E rate based on their credit score. Now, for us here at Michigan First, you're going to be right around 19%. For those of you who maybe have had cars financed elsewhere with companies like Credit Acceptance or Santander, you know that that credit score, or I'm sorry, that interest rate can be even higher than that. You can get up into the 20s, almost to 30%. So we're talking even more than what we are here. So for this individual, this member financed the same $25,000, it's the same exact car for the same term, 5 years or 60 months. Their interest rate is going to be around 19.49%. Now let's just look at the difference in the payment. Whereas the A+ member who has the advantage of having a good credit score right now is paying $451 a month. We have this member who's going to be paying $655. That's a pretty big difference there in payment. Just think of what you could do with an extra $200 a month, especially in this market. The big kicker here is how much money you're going to pay in interest over that 60 months. Over that 5 years, you're actually going to pay $39,000 for that $25,000 car. So let's look at this a little bit more in detail. Whereas the A+ member is paying $451 a month, the member with the lower credit score is going to be paying $655 a month. Okay, that's a difference of $203 per month just for the same car. The A+ member is going to pay a total of $27,000 or $27,113 for that car. So the E member is going to pay $39,000 for that same exact car. So you could save yourself, this is where we're talking dollars and cents out of your wallet, about $12,000 in interest. That's what a difference a credit score can make for you. Now, this is an extreme example, right? We're going from a very high credit score to a very low credit score. But even if we were in between there and you had a C tier in the mid 600s, even if we cut that in half, do you really want to pay $6,000 more for a car than you need to? Or in this example, do you want to pay $12,000 more for that vehicle? Absolutely not. We want to pay the least amount as possible for all of our goods that us as consumers buy. And you can use your credit score to your advantage to do that. So when maybe you've asked yourself in the past, I've certainly had members ask me, does it really matter if I have a 720 versus a 620? Does it really matter where my credit score is at? And I always try to use examples of like this to point it out. Yes, it does really matter. Unless you have money to throw away and burn, which very few of us do, it really matters, dollars and cents. Just think, if you could save yourself $12,000 over the next 5 years, what would that do for you? What could you do with $12,000 in 5 years? That's really what we're talking about here. So credit scores do matter, and they matter because they hit your wallet differently. So not all of us are blessed or privileged enough to have a good credit score. Bad stuff happens to good people all the time. Life throws you curveballs, and maybe you fall behind on your bills for a couple months before you can dig your way out of that and get yourself back on the right path. In times like that, your score may dip down into the 600s. It may dip down to the 4 or the 500s, and that's okay. We all go through times like that, but don't give up. There's always a path out of that to get your credit score back up to where you want it to go. So one of the things I wanted to focus on today is credit capacity. Now, we're going to get to what that is in a moment. But credit capacity is the one thing that you can improve on your credit score quickly that will allow your credit score to go up fast. Because sometimes if you're late on payments, you have some collections on your credit report, it can be a slow burn to get back up to that credit score that you want. But if you can improve your credit capacity, this is where you can get that instant bounce back almost in a month or two where your score can jump back up. So let's focus on credit capacity for a few moments here, let you know how you can improve that and what it can do to your credit score. Credit capacity is affected by revolving debt. Okay, so revolving loans are things on your credit report that you can spend, pay down, and reuse them again. Credit cards are a great example. You can go out and use your credit card. You can pay it all the way down if you want, then you can reuse that money. Even if you don't pay it down all the way, you can reuse that money until you get up to your limit, your credit limit, and then you can't use anymore. All right. So unsecured lines of credit are another good example of this. These are those loans that revolve. You can use them and reuse them and reuse them again. It's much different than, let's say, a car loan. A car loan is an installment loan. You get a certain amount of time to pay that loan off, and after you've made your last payment, you're done with that loan. That's not what revolving debt is. These are those loans that you can keep using, and keep using. All right. So now that we know what affects your credit capacity, what is credit capacity? Credit capacity, if you wanted to define it in a way that's hard to understand, the definition of credit capacity is the ratio of combined revolving credit balances to combined credit limits. That sounds like real fancy talk to me. I don't even understand that. So let's break it down. It's the percentage of your revolving debt that you're using or that's available but not used. So all of your credit cards, all of your revolving lines of credit on your credit report get added up to a certain amount of credit that you can use. All of your credit limits on all of your credit cards are shown as one amount. Okay. How much of that amount you're using, that's your credit capacity. Okay. So if you have $10,000 in available credit that you can go out and use, how much of that $10,000 are you using? It's a percentage of that. Now, this affects your credit score greatly. You can see on the slide here, it's 30% of your score. The only thing that affects your credit more than this is how well you pay your bills, but that's only 35%. So this is almost as much of your credit score as how well you pay, is how much of your revolving debt are you using. All right. So with credit capacity, if you can pay your credit cards down and you're not maxed out on your cards, the lower you get your balances on those credit cards, the higher your score is going to go. So for each percentage point of credit capacity that you gain, you can gain about a point on your score, right? So let's say you had $10,000 in available credit and you went out and you used it all. So you're maxed out. You don't have any available credit. Well, your capacity is going to be 0% because you're using it all. Now, let's say you just went out and in one fell swoop, you paid all that $10,000 off. Well, now you've gone from 0% available to 100% available. So you went from 0 to 100%. Now, if we look at the slide, it says each percentage point of capacity you gain, you get 1 point on your score. If you go from 0 to 100, you could potentially gain 100 points on your credit score from that. That's why this stuff is so powerful and that you can get an instant bounce back on your score. All right. So let's look at it a little bit more in depth. How do you calculate credit capacity? The nice thing is if you get a copy of your credit report, the credit reports do it for you. But if you don't have one and you just know how much available credit you have to use, you can calculate this on your own. So let's say we're going to use easy numbers here because I like easy numbers. Let's say you have $10,000 in available credit limits. Okay. Let's say right now you have $4,000 in balances. So how do we calculate that? Well, you take how much you have in your credit limits and you subtract how much you have in balances from that. And that's going to give you how much money do you have available to use right now. So in this example, with $10,000 in limits, you're using 4,000 of it. you have $6,000 in available credit. Okay. Now, if you divide 6,000 into your credit limits, again, 10,000, you get a percentage. That's 60%. Okay. So you have 60% available of your revolving lines to use. So in this example, let's say you went out and you paid off that $4,000 that you had in balances. How much can your score go up from there? Well, if every percentage point you gain is a point on your score, you could potentially gain 40 points on your score just from paying off those balances. And you can use your own examples here, however much you have in credit limits, what your balances are, and you can do the math to figure out how much your score could go up just based on paying off your revolving debt. Okay, it's really, really powerful stuff. This is one of those things that I try to educate our members on the most out of anything, because most of us know how you pay your credit affects your score. I think sometimes, and even I fell victim of this before I was in the industry, I thought that was the only thing that mattered with your credit score was how well you paid things. But almost as much as how well you pay is how well your capacity is doing. How much of your revolving debt is being used? The lower you get that, the higher your score is going to go. And it's very important to realize that. And this is the quickest way to make an impact on your credit score. All right. So that all sounds nice, Brock. We all know that, but not all of us have the ability just to go out and pay off all of our credit card debt. And that's fine. A lot of us in America do not, right? So how can we gain credit capacity? The first thing is to pay it down. So if you can't pay it all off, the more you pay and the lower you get those balances, the higher your score is going to be. Okay, so you might not be able to do it all at once, but the more you work on it and the lower you bring those revolving lines down, the higher your score is going to go. Another way to increase your credit capacity is to raise your revolving limits. So you could call and try to get an increase on your credit limit on some of your credit cards. It's going to work the same way. If you get a higher limit, all of a sudden, if you had $10,000 in credit card debt and you were using all $10,000, you're at 0% capacity. Well, let's say you called and you got a $10,000 increase on your credit card. So now your credit limit's $20,000 and you're only using $10,000. Your capacity went from 0, where you didn't have any available, to now 50% because you're only using half of it. I hope that makes sense for everyone. It's just trying to do the math there. But if you can raise your revolving limits, you can increase your capacity and your score is going to go up because of that. You can also do a combination of the two. Call, maybe try to get some of your revolving lines a little bit higher on their balances or on their limits, and also work on those balances. If you can do both of those, you can kind of hit it from both ways, and then you can try to get that score increase. All right. So one problem that I see some of our members run into is that the companies or the finance banks that they work with aren't reporting their home equity lines of credit the correct way. A home equity line of credit should be viewed as a mortgage on your credit report. So if you get a copy of your credit report, it should show that it's a mortgage. There are a few companies out there that report home equity lines of credit as revolving lines of credit. So they're going to show up in your credit card debt. The problem with that is when a lot of us have home equity lines of credit, we take those out because we have stuff that we want to do. We don't just take them out just for fun. And a lot of times we use those limits and we're close to maxed out on those home equity lines of credit. The problem is if the company you're financing that with reports it as a revolving line of credit instead of a mortgage, it's going to affect your credit capacity. So it has the potential to tank your score if that's not reporting as a mortgage. So if you get a copy of your credit report and you see that that's happening, you're going to want to call those companies and say, hey, look, you're reporting this as a revolving line of credit. It's not, it's a mortgage. It's attached to my house. Please start reporting this as a mortgage instead of a revolving line. And if they won't do that, maybe it's time to refinance it with Michigan First Credit Union. So just a little shameless plug there, but it's really important that you look at that and see how your things are reporting. Make sure that they're all reporting correctly. You also want to make sure that your credit cards are reporting your credit limits. There are a few credit card companies out there, even some of the big ones, that are going to show that you have a balance with their company, but they're not reporting what your credit limit is. So let's just say you had a credit card with Discover and you had a $10,000 credit limit with them and you were using 9,000 of it. If they're not reporting their credit limit to the credit bureaus, all of a sudden it looks like you have $9,000 worth of credit card debt that's totally maxed out, that's over maxed out because it doesn't even show a credit limit. If you see that on your credit report, if they're not willing to show your credit limit on the credit report, it may be time to make a change because they're not doing you any favors with your credit score. So that's credit capacity in a nutshell. It's very, very important to understand what it is. And we've given you some tips and techniques on how to increase it. So if anybody has any questions on that, feel free to add those in the chat. But that's the most crucial thing that we're going to talk about today because it has the ability to increase your score right away. And if you don't do it the right way, it also has the ability to tank your score right away. So you want to make sure that you do that well on your credit report. Now, from time to time, like I said earlier, life throws you curveballs. You never know what's going to happen. We all go through rough patches in life where we hit those potholes. And during those times, you want to make sure you try, if you can, to make sure your credit stays on track. Or sometimes if you have to miss a few payments, what can we do to try to get that back on the right path? So what can we do in tough times? Here's a few things that you can do. Keep in close contact with your creditors, especially with Michigan First and the way that we interact with our members. We know that tough times are going to happen. And we would much rather you get in contact with us, let us know what's going on, and we're here for you. We're here to see if we have any solutions for you that we can help you with in those tough times, because it's hard to do it alone, especially financially. So if there's any programs that we can offer to try to help you through those tough times, it's really important to keep in close contact with your creditors, just so you can let them know what's going on. You want to keep your arranged promises too. If you get on some sort of payment plan, you want to make sure you stick to that so you can always keep in the good graces of your creditors, and that way they can help you out in these tough times. It might be time to consider nonprofit credit counseling. You can come talk to us here at Michigan First and we can give you some recommendations for that. We can also even have a chat before then to see if you even need to go that route, because maybe there's something that we can offer on our end, some sort of product that can help you along during the tough times. But if you have to go through the credit counseling, there's certainly some bad apples out there that we can try to help you avoid. Most of all, like I've talked about a few times, see if moving your business over to Michigan First can save you money. I can't stress it enough how much we like to educate our members, how much you all mean to us, and we want to help you through tough times. And I know from personal experience, I have some family members that work for other financial institutions as well. They don't do that there. You know, it's just whoever walks in, they're helping them and they're leaving. We want to take the time with you, see if anything that we can do on our end will help you save money. So it might be time to see if that makes sense for you, especially during tough times. Things that you want to try to avoid during tough times is don't make arrangements that you can't keep. Be upfront and honest with your creditors. Let them know what's going on. Hopefully you can come up with a game plan there. But if you make arrangements, try to stick with those. This is a big one. Don't spend more than you have. And also, more importantly, don't try to borrow your way out of trouble. It's really hard to borrow your way out of trouble. A lot of times you compound the problem. So before you start to try to do that, get in and try to talk to us. See if there's some other solution available and see what we can do for you. But it doesn't end very well sometimes when you try to borrow your way out of trouble. Really important to not get involved with credit repair companies if you can. Like I said earlier, there are some bad apples out there. A lot of times when we talk to our members who have dealt with those types of companies, it's very late in the process, and it takes us longer to help get them out of that trouble than it would have if they just would have come to us originally. There's a lot of credit repair companies out there that tell you that they're going to settle with all your creditors, which is possible. The process to go through all that is really damaging to you and your finances and your credit score, though. A lot of times those companies are going to tell you, send us the money, and what we're going to do is go ahead and settle with all of your creditors. The problem is a lot of creditors out there don't settle until you're charged off on your loan. So what the companies are going to do is collect all of your money and just sit on it and let all of your loans go past due. And you know what that does to your credit score. You're just tanking that whole time to where you're probably down into the 400s even. And it takes a while to get out of there when you're down into the 400s. So instead of going through that route, go with a reputable company. Come talk to us at the credit union. If we can't do anything for you, we have those good companies that you can go with for credit counseling. But those credit repair companies really, really hurt a lot more of our members than they help. So you want to try to avoid them if you can. If you do go through a rough time in your life and you find that your score has gone down into the 400s, 500s, maybe low 600s, it's okay. Bad stuff happens to good people every day. And we see it here. We've lived it here. There are some things you can do to help reestablish if you find yourself in that situation, though. You always want to maintain a good relationship with your financial institution. They're most likely the ones that are going to be able to help you out of that situation the best. Clean up what you can. There's very few instances where you can snap your fingers and everything goes back to normal and everything's good again. There's a lot of times where you have to take baby steps. Start off small and then build your way step by step up. All right. We have some credit rebuilder loans here that help with that process, that get you on that first step, because you have to take that first step. If you do nothing, nothing's going to get better. There are ways that you can get there, but you have to take that first step to go. You have to take that first step to get where you want to be with your credit score. So even if you have to do a baby step as opposed to a leap, it's better than doing nothing. Clean up what you can to start and build your way from there. There's been so many members over my time here at Michigan First that we see in a very hard spot. And we had to do that baby step loan. And we follow them in their progression. They come and do another loan with us. Then they do another. All of a sudden, a few years later, they're up into the A+ again, and they're getting those best rates that they can. They're saving as much money as they can on car loans, like that example we looked at earlier today. All right. But to get to that promised land, sometimes you have to take that first baby step to get there. So don't be afraid to do that. And we're here to help you with that. Just like we talked about in that example earlier, until your credit score improves, you're going to pay more money out of your pocket. And especially in today's environment with inflation, paying more for cars, paying more for houses, and now rates are higher. We're paying a lot anyways. So you want to limit that as much as possible. And the best way to do that is to keep your credit score as high as possible. All right. Now we talked about ways to do that today. Get that capacity low. Make sure, or get that your capacity number high. You want to make sure you have as much available credit as possible so you can help your score. And if you do make mistakes, because we've all been there before, we've made mistakes with our finances, learn from those mistakes. Don't repeat those mistakes if possible. Learn from them, move on from them, and don't repeat them. And if you can do that and you can use those lessons, you're going to not repeat them in the future. And hopefully that means that your credit score is going to be higher. All right. So that's what we have for you all today. Very targeted and specific subject matter today. But really, in my eyes, if you are in a hard spot and you need to get your score high as quickly as possible, that credit capacity is the best way to do it. And we really wanted to focus on that today. And I'm going to turn it back over to Jeff and see if we have any questions that came up in the chat.
Yeah, thank you, Brock. Shared a lot of great information today in the last 30 minutes regarding the importance of developing and maintaining a strong credit score. So if we move on to questions, I do have a couple here. Here's the first one. What is the best kind of loan to take out to pay off my credit card debt? Are balance transfers to another card appropriate?
That is a wonderful question. That's a really great question. It does matter what kind of loan you take out to pay off your credit cards. If you do a balance transfer, you're taking that revolving debt that you have, that credit card debt you have, and you're just putting it on another credit card. That's not going to help your capacity at all. Because remember, the only loans that affect your capacity are revolving loans. They're credit cards. They're revolving lines of credit. The best type of loan to take that credit card debt and put it into if you have a home, is a home equity loan or a mortgage, because you're going to get the lowest rate possible on that. A mortgage does not affect your credit capacity. A mortgage is an installment loan. You take it out for a certain amount of time. After you pay it, it's done. If you don't have a home or you don't have any equity in your home, the next best route to take out would be a personal unsecured loan. A personal unsecured loan is also an installment loan. You take it out for a certain amount of time, and when you're done paying it off, you're done with it. Installment loans like that don't affect your credit capacity either. Only revolving debt does. So if you have $10,000, $20,000 in installment debt, try to pay it off, or in revolving debt, I'm sorry, try to pay it all off with an installment loan, because then you take all of your revolving debt away and your capacity will be at 100%. That's going to help your score the most. If you just do balance transfers, you're just moving it around in the same type of loan.
All right, great points there, Brock. Thank you. I do have another question here, and it is, if I'm currently not working, but will be starting a new job soon, do I need to wait to get a consolidation loan to help with my credit card challenges?
The answer can be yes, it could be no. It just depends on your certain situation. I can tell you that we have helped members in the past who haven't started their job yet, but we have gotten proof where they're going, what their income is going to be, and what they're going to be doing for work. So we know that sometimes you're in between jobs. If we can just see where you're going to go and how much money you're going to be making, we've helped several members who haven't started their new job yet with a debt consolidation loan. And the quicker you can get that process going, the quicker your score is going to improve. That way, when you start that new job, you've already hit the ground running. So you don't have to wait, is the answer to that. There's a potential you may have to, just depending on your situation, but we've certainly helped members before in the past who hadn't started their new job yet.
All right, thank you again, Brock, for that. I do have another question, and it states, I have 6 credit cards. My balances are always paid early or on time. Some of them I never even use, but keep open so they don't close. I've never had any negatives on my report, but my score is still low. Why is that?
There could be several answers to that. We'd have to take a look at your credit report to see if anything popped up on there that you don't know about. That has happened in the past with some of our members. There's also a chance that if you pulled up your credit report at a certain amount, at a certain time in the month, those balances are reporting to the credit bureaus. So all the banks and all the credit unions here in our country, they report their balances over to the credit bureaus one time per month. All right. So let's just say, for example, your credit cards all report to the credit bureaus on the 15th of the month. Well, if you have balances on those and you don't pay them off till the 17th or 18th, when those credit card companies report to the credit bureaus, they're going to show that you have a balance. And if they do show that you have a balance, that can affect your credit score. So it all depends on when they report to the credit bureaus versus when you pay those cards off. So you might be showing those on the credit bureaus and not even knowing it.
Yeah, good point. And ultimately, folks, if you're in that sort of situation, it is indeed, as Brock mentioned earlier, best to come on out to one of our branches or call us, and we can do a thorough credit review for you and find out exactly what's affecting your score. All right, the only other question that I have, Brock, at this time is about providing access to the recording here. And I'll let everybody know that we will have a copy of this recording out on our website, michiganfirst.com, for all members to view. It should be no later than tomorrow morning. So expect to see that sometime in the next day or so. And you'll be able to, again, listen to the recording in full. So it looks like we've addressed most of the questions presented. We're about 36 minutes in. If nobody has any other questions, I'll just mention real quickly that if you are indeed interested in discussing your individual credit situation with one of our credit professionals, make sure that you visit one of our 29 branch locations across the state. You can call 1-800-664-3828. Again, that's 1-800-664-3828. Or, of course, you can visit us online at michiganfirst.com. On behalf of our 400 plus team members, I want to thank you all for participating and again for supporting Michigan First Credit Union. That's all for now. So until next time, please enjoy the fall season. We'll talk to you again soon. Thank you.